All right, let's talk about one of the most important and honestly one of the most emotional parts of trading, how to actually keep your profits. You know the feeling, you've done all the work, you found a great trade, and now you're sitting on some really nice paper gains. But the big question is, how do you make sure all that hard work doesn't just disappear? That's what we're going to get into today.
And man, this quote just hits the nail on the head, doesn't it? It's a feeling every single trader out there knows. That anxiety that starts to build when a winning trade starts to pull back, even just a little. It's that knot in your stomach, that voice in your head asking, do I take it now? Do I wait for more? That right there is the central challenge we're here to solve.
So let's really dig into what the problem is here. Nailing a perfect entry feels incredible, right? It's that rush we're all looking for. But here's the thing. It is, quite literally, only half the battle. If you don't have a crystal clear plan for when to get out, a sudden market reversal can turn an amazing trade into a break-even, or even worse, a loss. And there's nothing more painful than watching a big green number on your screen just evaporate.
So our mission today is to build that bridge, the one that connects a good trade idea to an actual profitable outcome. It's all about moving from just passively hoping for the best to actually managing your trade. We're turning those paper profits into real, secured gains in your account. And we're going to break down two really powerful ways to do exactly that.
Okay, first up, let's talk about a tool that should be in every trader's arsenal, the trailing stop loss. The best way to think about this is like an intelligent, automated safety net. It literally follows your trade up, actively protecting the ground you've gained from the market. Now, the key word here is dynamic. See, a regular stop loss is just static. You set it at one price and it just sits there. But a trailing stop, it's alive. As the price of, say, gold climbs higher and higher, your stop loss automatically moves up right behind it. But, and this is the genius of it, if the price of gold suddenly drops, your stop loss stays put. It digs its heels in, locking in that new higher profit level. It only ever moves in one direction, the one that makes you money.
Okay, so let's make this super concrete with a Bitcoin example. Let's say you go long BTC. Step 1, you're in the trade. It's moving your way. Step 2, you place your initial stop loss to protect your capital, just like always. Now, step 3 is where the magic happens. As Bitcoin rallies, your trailing stop follows it up. You might set it to trail by a certain percentage, or maybe based on a volatility indicator like the average true range, to give it some room to breathe. And then comes step 4. If Bitcoin pulls back by that amount you set, boom, the order triggers, the trade closes, and you've automatically banked the profit between your entry and that new higher stop level.
And that right there is the beauty of the trailing stop. As soon as your stop has moved up past your entry price, you've basically created a risk-free trade. You are now in a perfect win-win scenario. Either the trade keeps running and you make even more money, or it reverses and closes you out for a profit you've already locked in. It takes so much of that emotional, gut-wrenching decision-making right out of the equation.
All right, so that's the trailing stop. Now let's pivot to a different, more structured approach, one that's especially useful if you're holding stocks. It's called the protective collar. And if the trailing stop is a safety net, think of the collar as buying a full-on insurance policy for your position. It's a very deliberate strategy designed to give you total peace of mind.
So what exactly is this thing? Well, a protective collar is a hedging strategy. It's something you use when you already own at least 100 shares of a stock. You've got some nice gains, and you want to protect those gains from a potential drop without actually having to sell your shares. This is incredibly useful around big, uncertain events like an earnings report. So let's pull back the curtain and see how this thing is built. It's got 3 key parts. First, you've got your 100 shares of stock. Second, you buy a protective put option. This creates the floor. It gives you the absolute right to sell your shares at a set price, meaning your position's value can't fall below that level. And third, you sell a covered call option. This creates the ceiling, which caps your potential upside at a specific price. And this is where the strategy gets really, really elegant. The two pieces, the floor and the ceiling, work together perfectly. The protective put, your floor, that's your insurance policy, and it costs you money, a premium. But the covered call, your ceiling, that's how you pay for it. You collect a premium for selling that call, and in a lot of cases, the money you bring in can completely pay for the put you bought. You can essentially get insurance on your stock for free, paid for simply by giving up some of the potential future upside.
Okay, but when would you actually use this? Let's take that Microsoft example. Imagine you own 100 shares, and you've got a fantastic profit on them right before their quarterly earnings report. You're feeling a little nervous. What if they miss expectations and the stock tanks? Well, instead of selling and creating a taxable event, you could put a collar on your position. This protects you from a nosedive while still letting you participate in some modest upside if the news is good. It's perfect for managing risk around a very specific event.
Now, we have to be real here. There's no such thing as a free lunch in trading, right? Both of these powerful strategies come with trade-offs. It is absolutely essential that you understand them before you start using them. Protection always comes at a cost, whether it's an actual cost or an opportunity cost.
And this table here breaks down the primary risk for each one. With the trailing stop loss, the biggest risk is getting shaken out. You know, the price dips just enough to hit your stop, knocks you out of the trade, and then immediately rips higher without you. It's frustrating. For the protective collar, the trade-off is much more obvious. Your upside is capped. If that stock goes on some insane, explosive run, you're going to miss out on any of the gains above your call's strike price.
And this quote just sums it all up perfectly. With a collar, you are making a conscious decision to trade unlimited potential gains for guaranteed protection and the ability to sleep soundly at night. And for a lot of traders, especially those with larger positions, that certainty is worth way more than the possibility of a home run.
So, we've covered two powerful tools, but here's the most important part of this whole explainer. The best tool in the world is completely useless if you don't have the discipline to use it. At the end of the day, this all comes down to having a plan, and more importantly, having the mindset to stick to it, choosing discipline over emotion every single time.
And these right here are the key disciplines you have to build. First, and this is non-negotiable, your exit plan cannot be an afterthought. You need to know how you're going to protect your profits before you even hit the buy button. Second, you have to shift your goal from trying to squeeze every last drop out of one trade to preserving your capital over the long run. And third, you have to fight that fear of missing out, that FOMO that whispers in your ear to just hold on a little longer. That's usually how great trades turn into bad ones. And finally, when you have a plan, you have to trust it. Execute it like a machine, without hesitation. So if you take one thing away from all of this today, let it be this. The mark of a truly successful trader isn't just their ability to find winners. It's their discipline to consistently keep what they've won. It's about moving from being a trade finder to being a risk manager. It's all about building a system to protect your profits.
And that pretty much wraps it up. We've covered a couple of powerful strategies, but of course, there are plenty of ways to do this. So I want to leave you with a question. For those of you out there trading really volatile assets like Bitcoin or gold, what's your go-to method for protecting your profits? Drop it in the comments below. I'd love to see what's working for you. Thanks for watching.